Welcome back to the Alternative Investing Doctor podcast. I'm your host, Dr. Keith Grosshans. In today's episode, I'm sharing an expensive lesson, how I'm about to lose $50,000 in a real estate syndication, and what every physician investor needs to know about these deals. Let's dive right in. Two years ago, I invested $50,000 in what seemed like the perfect real estate syndication. The pitch deck showed 117% total returns over 5 years. Today, I'm mentally writing off that entire investment. If you're a physician who's been pitched on syndications, this video might save you from making the same expensive mistake that I did. Let me tell you exactly what went wrong. Syndications are often heavily marketed to physicians. They're sold as a passive investment that's a good alternative to the stock market or the bond market, and they're really supposed to be hands-off. This is the way that the general partners or the deal sponsors will usually pitch them. They'll see physicians as sources of capital who really don't have the time to be involved into the day-to-day aspects of these investments. They put together very professional looking pitch decks, and they have very impressive projections for annual returns as well as overall returns, usually over a 5-year time horizon. They're often going to require at least a $50,000 investment, so this makes them feel quite exclusive. And they're also usually going to be limited to accredited investors, again, kind of increasing that exclusivity factor. And really, one of the big promises is, because these are sold as extremely passive, they promise to solve our time problem, where we're very busy working day to day, seeing our patients, doing our clinical work, and don't have the time to put into investments. But here's what they don't tell you about how these deals really work. This deal in question was on an apartment complex in the Dallas-Fort Worth area, which is considered a very hot market and has been very popular with real estate or apartment syndicators. The deal sponsors were experienced and actually had a really good track record with multiple profitable deals preceding this deal. The pro forma projections and the offering memorandum looked fantastic, suggesting that we could expect about 117% total returns over the 5-year investment horizon, and there was expected to be a 7% preferred annual cash flow. These check all the boxes for physician investors who are looking for good passive income. However, I should have dug deeper into what these projections actually meant. So what went wrong with this deal? Well, market conditions started to change faster than were projected in the financial modeling with the marketing materials. Occupancy dropped below sustainable levels. Distributions actually were stopped 6 months ago because of some of the financial difficulties due to rising costs. And because of the low occupancy not being able to offset rising costs, property refinancing looks quite unlikely at this time. For this reason, the current status of this investment looks like it could be a total loss. At this point, if I have any return of capital, I would consider this to be a bonus or a blessing. So what did I miss during my due diligence? Well, let me show you some of the red flags. The conventional wisdom within the real estate or apartment syndication space is to use specific annual increases in both cash flow from rental increases and a certain fixed increase in expenses. Now, this meant that actually rent growth was overly optimistic. We actually ended up hitting a period of time where rent growth was actually negative. It was actually decreasing, not growing. And the initial projections were for at least 3% annual growth of rents. The competition within the market was also underestimated. There was a significant amount of new supply that came online from brand new built apartments in the Dallas-Fort Worth area. And then the other main issue was that this property was financed with short-term debt at a time when there were already some discussions about interest rates potentially rising. And this was debt that had no debt ceiling and was adjustable. And this meant that the deal sponsors had to purchase what's called an interest rate cap to prevent that interest rate from going too high and significantly decreasing the total amount of cash flow. Because of the issues with occupancy and rising expenses, especially insurance being one of the biggest increases over the last few years, this has prevented the ability to refinance into a more stable debt product, just because those typically require greater than 90% occupancy consistently to qualify for. So there are certainly questions I should have asked. I should have asked more about how the refinancing was going to happen and how this deal was stress tested to account for possible changes in the interest rate, insurance prices, occupancy rates, etc. Normally these deals will be stress tested, but that is not always shared explicitly during offering memorandums or webinars that often accompany the pitch for these investments to prospective investors. I think it's very important to make sure you're educated on all of the risks of these particular assets and how different market cycles can actually affect them. I think that the changing market conditions with rising interest rates caught a lot of people by surprise, and this caused a whole lot of stress within commercial real estate at large, but definitely apartment syndications as well. This is exactly why I've shifted my focus to something completely different. If you've had either positive or negative experiences with apartment syndications, go ahead and share those experiences in the comments. If you're looking for other ways to invest your hard-earned capital, subscribe to learn more about note investing and help me build this community for other physicians who are interested in mortgage note investing.